I'd like to introduce you to a concept that is very popular and necessary in the world of financial markets, and that is the forward rate. Now let's try and understand what is a forward rate and what's the need for a forward rate. The hypothesis in the context of a forward rate is that investors would want a 2-year security to offer a return that is similar to the anticipated return from investing it in 2 consecutive 1-year securities. So it's a 2-year security, you invest for 1 year and you invest for 1 more year. Now the returns you would get by doing this should be the same as what you would get if you invested it in a 2-year security. That's a hypothesis that governs the forward rate. Now let's try and understand that in greater detail. The formula says 1 plus IT2 to the power of 2 is 1 plus IT1 into 1 plus RT plus 1, 1. IT2 is the known annualized interest rate for a 2-year security. IT1 is the known annualized interest rate for a 1-year security, and RT plus 1 to 1 is what will be the rate today for a 1-year security whose term is going to start 1 year from now. The 2-year rate should be equal to the 1-year rate and the 1-year rate starting 1 year from now. In the example that you see, the 1-year rate is 6%, and as per the term structure of interest rates, the 2-year rate should be higher than the 1-year rate, assuming the yield curve is sloping upwards. So the 2-year rate would be 7%. So you got a 1-year rate that is 6%, and you got a 2-year rate that is 7%. If somebody were to come and ask what would be the interest rate he or she would get if they invested the money 1 year from now for a period of 1 year, that's the forward rate, and that is calculated using the formula that you see, and that turns out to be 8.01%. Now let's see what happens when the interest rates for 1 year and 2 years would change. So let's say in that financial market the 1-year rate drops to 5.5% and the 2-year rate drops to 6.25%. You will immediately find that the new forward rate being quoted for an investment of 1 year starting 1 year forward also changes to 7.01%. So this is the relationship between the rates, spot rates being quoted now, and what the forward rate would be starting at a future point in time.